All right. What's going on, everybody? Is it Friday yet? I'm ready. Seen some really interesting headlines this week, right? Where they've been hyping up that we're back. We made it back. We didn't keep selling off. And so far, things are looking really good. We're through, the worst part of the earnings. We've still got the House and Senate, a little bit of issues there when it comes to funding, but otherwise, we're looking pretty good. Some threats to keep in mind is these tariff deadlines, right? Some of this stuff is on hold April 2nd, 90 days. So you just count out from there and start figuring out, that like a cycle, it's going to come back around again. Now, I I think the I think the put is in. And I seen an article on this. I kind of liked how they were saying, in the first Trump administration, we had what they called the presidential put, the Trump put. If the market got soft or it looked like it was going down, he'd tweet or do some other shenanigans to pop the market back up. So the presidential put, and for the last 20 years or so, we've had the Fed put. Anytime things get weak or squishy, the Fed goes out with the plunge protection team and they pop the market back up again. This is not new stuff, right? It's been around for a long time. So in the new administration, the Fed made it clear they weren't willing to come in and save the market. They were still dealing with inflation, and they were worried that the new administration was going to make inflation worse, and so they were not going to come in. So no Fed put, set that aside. And then Trump said, "I'm not watching the market. I don't care what it does. We've got things to do, and I'm not going to pay particular attention to equities and whatever the market is doing." So no presidential put. And then, of course, he threw on the tariffs and beat the market down. And he showed no signs of backing off on that whatsoever. And it was tied to the new Secretary of Treasury, Scott Bissett, and his 333 plan. Everything was on schedule. Nobody was blinking, right, or calling a bluff until the bond market and everything changed. Now, the president has a softer tone. He's playing nice with others. They are putting together the tariff deals, going out of their way to calm the market down. And there was a phrase that was being used for a while that had to do with the chaos, that it was a part of the strategy to cause confusion and fear and uncertainty in the market as a part of a negotiating tactic. They wanted that confusion and uncertainty. And now they're changing that around and they're going the other way. And the market's response has been a rally back up to where we were in February. That fast. It's all it took, right? For a little bit of stability and an end to the calamity. And ta-da, we're back up to where we were. The question is he done? Because if he's done, if the bond market has taught him, that there is a limit and he doesn't get wild again, then that's it. Now, we talked about all of this back in November, December, January. We didn't know it was going to be tariffs and wildness like this, but we did talk about how the market needed a real good sell off. Uh, Jeremy was here, right? We had a nice chat about it. And the idea was they could do it later in the administration or they could do it pretty early on in the administration. But one way or the other, it needed to happen. And that once we got it out of the way, things would be much better at that point. Well, again, ta-da, we got it. Okay, it's out of the way. Unless something breaks or goes seriously wrong, then we should be able to not make new lows from here, right? That 48, whatever it was, 48 and a half should be the low. But we can stay in this really wide range for a long time. We don't have to break out and make new highs, right? This can be our life for the foreseeable future, years. It doesn't owe us anything. I don't think it's going to be years. We can see how quickly the Mag 7 come roaring back and you know, add AI to that and then quantum to that. I just don't see how we could stay range bound into that. But quantum ain't here yet, right? At least according to NVIDIA CEO. And AI, we have the agents that are doing pretty good, but most of the popular AI isn't thinking anything at all. It's just a really fancy Google search, right? It's not connecting the dots and actually intelligently making an assessment of the information that it's been given. So there's still a lot of upside left. Always we have risks on the table, right? The bricks in the wall of worry that could send us to the downside. A financial crisis at this point would be the only thing really viable on the table that can crash us without, say, something drastic like a COVID type situation. That can obviously drop the market, but it would have to be something really big, right? So we can always keep our eye on the usual suspects, the sectors. Now I use these nine, but there are a lot more than this. And you can replace them. I use tech, really generic, but you could put in, SMH chips. I use XLF, but you could just put in banks or I got consumer discretionary, right? You can swap those out. They don't have to be just these, but they need to be in this theme. It's growth versus value, really. It's the generic way of doing it where we can look at the sectors and the industries. If we're going to keep the highs or at least not revisit those lows, then growth needs to outperform value. But keep in mind when you hear that growth versus value, it doesn't mean that value goes down and growth goes up. It just means that growth is outperforming value. It's doing better than value. And there are still uh, problems that the market's going to have to deal with. And what we have to be mindful of is how much punishment the market is going to inflict, right? So, Walmart today, I posted a video from Schwab. They were talking about Walmart, and they're talking about how Walmart, strong earnings, it'll beat the outlook, blah blah blah. What if Walmart comes out with a forward guidance that is the either or that we saw other companies doing, or they just flat out say we're not going to give you forward guidance? I don't know. The market is going to like that very well. And the docks in California, and well, the docks on both sides of the ocean of the continent are saying, shipping is down. They're not expecting the shipping to pick back up anytime soon. We'll be lucky if we're able to fill the shelves at Christmas. So, we're getting close to the halfway point on the year. And when we get into the second half, we'll have to start thinking about the holidays and the next earnings cycle. And so don't lose sight of the obvious stuff. It's easy to get lost in the weeds on bonds, treasury yields, FX markets, what's going on in Germany, China, Japan. But there's also just the simple stuff like Americans being able to go into the store and find something on the shelf that they want to buy. So, kind of keep that in mind. Supply chains are disrupted. There's going to be, yeah, the price of tea in China. I remember my mom used to say that too. Yeah. There are still consequences that we haven't seen yet, right? So, just kind of be mindful of that. But otherwise, the longs that I had announced that I was taking, I wasn't necessarily suggesting everybody else do it. I went back and looked at the dates, by the way. I thought I had one in March, but I didn't. I had two in April. Um, I thought it was like late March, but no, they were both in April. One was April 2nd. So the big day, the big announcement. What did he call that? Liberation Day was the first one. And then the second one was later in April. So 4/2 is when the first long was announced, and it was for mega caps. And then later, I know it wasn't at this low because that would just be too awesome. I think it was more somewhere in the middle of this is where I called out long on large caps. Now this isn't a ha ha. I was right. Even broken clocks can be right twice a day. It's the idea that there was a plan, there was a reason for these longs to be effective, and if I was wrong, there was still things on the books for what was I going to do about it. I don't know about you guys, but when I'm wrong, I don't like to just lock in a loss and move on. If I can help it, I'd like to adjust that loss in some way and maybe, not take as big as a loss. So adjust it, defend it, modify it, roll it, do something with it. But the plan worked. We've had the push to the upside. We may get a chance to take another run at it if we get another sell off. But otherwise, things are looking pretty good. So we had a request to talk about options, and we're going to get into that. But if you guys have a particular stock that you want to look at, or an indicator that you want to go over, if I deviate and you want to back up and ask questions on something, by all means, throw it in there. Otherwise, let's talk about options for a little bit. When it comes to options, I've noticed the speculation crowd is really what takes the cake. You look on social media, it's what everybody's talking about. They bought a call or they bought a put and it made 200, 300, 500% profit. And they're all geniuses who never lose, apparently. And it's all speculation. When you just buy an option, hoping to close it later for profit, then you're speculating. That's what it's called. You can call it guessing, whatever, but it's called speculation. It doesn't matter if it was a long based on fundamental analysis, technical analysis, the Ouija board, a crystal ball, still speculating. But that wasn't what options were designed to do. When they were first introduced into the market, they were designed to enhance a stock trade. So you have a stock trade, it's kind of a dud, it's not doing much. You bring options into the picture and you can improve your returns on this stock that is underperforming in your portfolio. That's what they were really designed for. Then it was added to that hey, we can use it to increase how much stock we have in our portfolio, so we can accumulate more stock using options. Yay! But again, it was designed to help stock traders with their positions. Now, between the time that we started using options into the time when everybody had a cell phone and computers were in every home and the internet was providing intraday trades, at some point just buying options for speculation became the most popular way to play. So when new traders to options decide they want to trade options, that's generally what they lean towards. And the brokers love it because they make money on commissions. So they will restrict you from level 3 or level 4, and they'll say, well, we're not going to give you permission for spreads. That's complicated. We're only going to give you permission to buy and sell, to buy, to open, and sell, to close your options trades. So they encourage it. Speculation trading. It can be done with small accounts, so everybody loves that. It's leveraged profit. Everybody loves that. The confusion comes in on what are good options and what are bad options. And this isn't the idea of is it a good trade or not. I went long and the market went down. I was wrong. I went short and the market went up. I was wrong. This isn't about that. It's what is a good option? How can I bring up an options chain and look at it and say, yeah, these are really good options? Or look at it and say, these are really bad options. I don't want to trade this trash. Because one thing that experienced traders have an edge on when it comes to trading options is that we know what trash looks like. We won't take the forced loss that newer traders will take because we won't take those really nasty options trades. We can spot what they look like and we avoid them. It doesn't sound like much, but when I get options questions from new options traders, and it'll be in some trash company that nobody's ever heard of that has maybe 25 options traded in the entire day, and they can't understand why the trade is not working out and they lose money. So, just avoiding something as simple as that gives you a leg up. So what does good options price? What does good options look like? And what does bad options look like? Generally speaking, we lump that into liquidity. It's a really fancy phrase, but liquidity is a multi-angled perspective. It's not just one thing. If I see weeklies, that's a sign of liquidity. The problem is that's not good enough by itself. If I go to something like Caterpillar, Caterpillar has weekly options. It's a well-known company. And yet, if we look at the options, this is trash. Look at all these NAs. It shows that these strikes have not been traded today. There's not even any money in it. It's just zeros all the way out. And on the ask, it's just a bag holder hoping that somebody will take their problem away from them. So this is a very illiquid market, but it has weeklies. So that alone isn't good enough, but it's a good start. If I was running a filter, one of the first things I would filter for is, hey, does it have weeklies? Because I know guaranteed if it doesn't have weeklies, it's not going to be liquid. If it does have weeklies, it might possibly be liquid. So another thing that we want to look at when it comes to liquidity is what's the shining example of liquidity? That would be SPY. On any given day, something might have more liquidity than SPY. On that one day, say Riot could get, the whole GME Reddit crowd piling in, and one day it may get more options traded than SPY. But it wouldn't consistently outperform SPY when it comes to liquidity. So it is your benchmark of what perfect, or as near as we can get, perfect liquidity looks like. It doesn't get any better than SPY. So if you ever have doubts of the thing that you want to trade, compare it to SPY. SPY has a really tight bid-ask spread. It's not perfect, and when we go farther out in time, the spread gets wider. That happens on every market. But even 37 days out in the current environment, I'm only looking at about 5, maybe 6 pennies of difference. That's not bad. That's not bad at all. And if we came into the front, say 5 days or less, then it's even tighter, right? 2 or 3 pennies. This is so tight that if you're day trading it, you can market order in and market order out. We would never suggest you actually do that, but you could. I have, because one of the problems when you're day trading is trying to get filled when the darn thing is moving and price keeps moving away from you while you're trying to limit order in, and then you adjust it and it just keeps running, right? It's a options shenanigans. So you just market order in, and you can actually do that with SPY and not get your face ripped off. Try that on Caterpillar. Yeah, you could lose $3 just getting in. And I don't mean 0.3, like 3 pennies. I mean like $3, $300 of slippage if you try that on something that's illiquid. So a really tight bid ask spread, not in one expiration either, but all up and down the chain. That I can look in different places and find a tight bid ask spread. That's a really good sign of liquidity. I should also be able to see a lot of volume traded. Open interest is nice. It shows that there are trades that are being carried from day to day. So it's a good to see, but intraday trading activity is a really good sign of liquidity. So seeing, triple digits is a good start. Seeing thousands, even better. And not just on one strike, on multiple strikes and on each side of the road, calls and puts. Because contrary to popular opinion, puts are used in bullish markets, calls are used in bearish markets. I know that may be confusing to new traders, but you have to let go of the YouTube internet trash that tells you that puts are only for shorts and calls are for longs, because they're not. We have so many options when it comes to trading options, so many choices. We can trade them any way that we want. And a lot of times we use puts in a bull market and we use calls in a bear market. So we want to see liquidity on both sides of the road. Lots of volume, a tight bid ask spread, and then we have strikes to deal with. Now, this one's a little arbitrary when it comes to strikes. I try to gauge it on how expensive is the stock itself. So we go over to something like Google. This is less than $200, and we have $2.50 wide strikes. That's not bad. Apple, it's just past $200, and we still got that $2.50 wide strike. Again, that's not bad. So if I do bring up a company that has, say, $5 wide strikes, I would expect the stock price to be a lot higher. If the company is $100 and it has $5 wide strikes, well, that's not good. That's a sign of illiquid market. There should be so many strikes available because there were so many traders willing to trade it that they just kept opening more strikes. The market makers, the dealers, the books, they added more strikes. And we can see on Caterpillar, if we look on the put side where it has more trades, it went into the 2.5 strikes. But on the call side, which is not yet as liquid as the put side, it's still hitting $5 wide strikes. So it's an example of we have some liquidity up here, we don't have it down here, and it's being reflected in the strikes. Now, the strikes by themselves, it's not good enough. And the fact that it says weeklies all by itself, it's not good enough. Even the bid ask spread by itself, it's not good enough. But we want to take all of these pieces and put them together so that when we're trying to identify, does it have liquidity or not, that we can check all of those things. It has weekly options, narrow strikes, a tight bid ask spread, lots of volume, lots of open interest. It's on both sides of the street. And if I spread it out and run down the road, that I should find that liquidity even as I travel farther out in time. Now, to be fair, monthlies are the go to. So if you get 90 days out, 120 days out, if you even find weeklies out there, you probably won't find a lot of trades in those weeklies. At that point, it's very likely going to start to gravitate towards only the monthlies. But even those monthlies should show some institutional participation. We can see it here with SPY, 11,000 on that strike, 10,000 on that one, 18,000 on that one. Those are big positions that are being carried by market makers or some institution, some fund, and they're still being traded. There's more being added to it. So it's got activity, it's got volume, even farther out in time. So that's how we know what good looks like. Bad would be no weeklies, a horrible wide bid ask spread, $5 wide strikes or worse, $10 wide, even close to expiration. Because SPY, we've got 5 wide right here, but I'm 200 days out. If I get up front and I look at something that's 10 days out, I've got $1 wide strikes. Here's 50 days out. I've still got $1 wide strikes. Can we trade something that has really bad liquidity? Yeah, I mean we can trade anything. Whether or not we should becomes an issue. Liquidity can cause you to get a losing trade. It can cause you to get stuck in a trade where you can't get out. And then you have to wait until it gets close enough to expiration that you can get out. It really sucks to get stuck in a trade that you're winning and you can't get out of. And you watch that winner go to a loser and you still can't get out. And when I say that you can slip hundreds of dollars when you go to get into a trade, most new traders don't grasp this logic because you're not feeling like you just lost $300 to get into that thing. And you think, well, what are you talking about? How did I lose hundreds of dollars to get in with that wide of a bid ask spread? You're not feeling that loss, but you would later on, especially when you go to get out of it. So here's SE. It's got weekly options and it has 35 cents at a bid ask spread in the money. That's not bad. If I market order into that and I buy it at 21.55 and we run up one and I sell it at 23.95, it sounds pretty good, right? And we can do the math and see how much money I made there. But if I was to actually work the order and catch this on the mid and then work the order and get out on the mid, I would make more money because I didn't pay up the most money to get it and I didn't sell it the cheapest I could sell it. If you're holding something of value, you don't want to sell it to the cheapest person who wants to buy it. You want to sell it to someone who's actually going to give you some money for it. So a wide bid ask handicaps your position that way. You have to work the order and hope that you have enough liquidity that somebody in the middle is actually going to take your trade. If it only has one trade done today, look at the volume here. There's only been 4 trades done on that strike. I'm sure those 4 people would haggle with me about where I get filled, and they would not want to pay me right in the middle. They wouldn't take my position in the favorable way for me. They would do it in a way that's favorable for them. But if we have competition, if we're all fighting over it, we're likely to get a much better price. So liquidity will help you get in, it'll help you get out, it'll help you avoid slippage. You won't completely avoid it, but do what we can. When there's only 2 pennies to slip, there's not a lot of room to slip, right? As opposed to 2, 3, 4, $5. So that's a nice broad outline of what good options look like and what bad options look like. And I'm a little bit of an options snob. I don't like bad options. I won't trade them. I will just leave it alone and I'll go do something else. Even on the long that I called out here at the 1st of April and later in April, I wanted to go long the market. The options were trash. in SPY, the Qs, the SPX. I didn't like any of it. So I didn't trade any of it. I went and I got mutual funds. I just avoided the entire situation. I was only working with a $10,000 account, and buying shares of SPY at 587 wasn't really going to make me much money, right? So I went with mutual funds. They're cheaper. I was able to buy more of them. And while they aren't leveraged the way that options are, I didn't have to worry about the handicap. It's not the perfect world, but it's the trader's world, right? It's the way we have to deal with it. Got to make decisions. So going forward, you can identify if something has quote good options, decent options by looking at its liquidity. And some concessions can be made if you're trying to get stock. If you're not speculating and you're instead going to protect a stock position or in some way enhance a stock position, liquidity doesn't have to be as important. But if you're speculating, it matters. And if you get into spreads, butterflies, iron condors, it matters because those spreads have multiple contracts that have a bid ask, and you've got to meet the bid ask on every one of those. That can get really complicated if you're doing something like an iron condor out of the money on an illiquid product and there's not a lot of trades there, right? The iron condor's got four contracts, two calls, two puts, two are short, two are long. And if it's an illiquid market, you got so many places to get hung up and get stuck. Either you don't get filled at all, or you have to keep adjusting the order until you finally do get filled, and now you're handicapped. And then you're going to have to do the same thing to get out, and you're handicapped again. On the Discord, we've got some really good examples of what options callouts look like. So we can just come down to trading ticks here and, oh, I don't know. Let's see, golden sweeps. So if I was to Google golden sweeps, it'll tell me it's something like plus 20,000 within X period of time. I can see that this one is all the way out in October. I don't like my golden sweeps that far out in time, but we didn't code this one, right? This is just whatever we found on the site. Still, a golden sweep, it's pretty generic. We know what it is. It's just a big sweep. That is not enough to take a trade, but it is enough to get us looking in the right direction. If we see Hood, for an example, has the 95 strike with a golden sweep, and then 3 minutes later it gets another one, and then another one, and another one, you kind of get the idea like, dang, they must be in there hitting Hood hard because they're getting hit again and again and again, especially if it's the same strike and it's big size over and over. We had one here on Google and then a different one on Google, two different strikes, not the same. And they're really far away in time. This one's March, that's June. So, that looked good at first glance. Like, oh, wow, look at that. Two Googles. Yeah, nope, it's not what we want. Right. So we got a bunch of NVIDIA here 153, 151, 140, 200. It looks like they were all back to back. Boom, 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 boom. But that's 2026. That's the end of May, mid June, another mid June. So at least those two are the same expiration. And they were all done at the same time. It's got a timestamp 1144. So if we're trying to find some quote unusual options activity, repeat orders, it's the easiest one that you can ever use because it's just like it sounds. A lot of orders are coming in and they're repeating over and over again. That's perfect. It doesn't get any simpler than that. If we want to get more complicated than that, then we can focus on, you know, was it a new expiration that didn't have a lot of open interest? Were the size of the trades coming in greater than the open interest? How far out in time were they? So we can get more complicated on top of it. But if you want a good starting point, look in the Discord. Look at the options that are getting called out in these golden sweeps because they are a perfect representation of liquidity, right? Somebody's coming in and buying up a lot of options, and it can get you pointed in the right direction. Even if it's not enough information to tell you was it bought to open, sold to open, that's where you can look at time and sales to kind of suss that out and figure out if it was one or the other. So if I type in golden sweeps, we get what's a golden sweep, but we want to get a little better than that. We want Trady Ticks. What's a golden sweep, right? Because that's the one that we have in the Discord. Now, I'm pretty sure they've got some YouTube videos on this too, but we can see that it's over 1 million in premium and it's either slightly in the money or it's out of the money. That's it. They're not looking at time at all. For me, I like to look at time. I don't want them, all the way out in October. But it doesn't change it for anybody else, right? That just changes it for me. So we've got the golden one, and I think, yeah, I think these bullseye trades are also options trades. So let's bring that one in. Nike call, this much premium. There's your volume. They're telling you to buy it. It's the 60 strike, and it has, I believe, confidence. Yeah, there it is. So obviously, if they say we're not very confident in this trade, we think it has a 30% chance of winning. Okay, yeah, probably not going to mess with that one. On the other hand, if you come in here and it says, it's a 85, 90% confidence, hey, you got to have a greater expectation of profitable trade. Here's a 73. I'm rounding a little, but you get the idea. They're not all going to be in the 60s and 50s. And I know they've got 80s. You just have to watch it for when they pop in here. The thing is, what a lot of people end up asking me when they see something like this is, well, how did they find it in the first place? Well, I can give you confidence, right? You want to know where the confidence is, it's the delta. So if we come back in and we look at SPY and I say, this 587 call, it's got some light volume today. And the bid ask, it's right at the money. The bid ask is not that bad. You could totally trade this for a long. It's got a 54% chance of being profitable. There's your confidence because that's your probability of profit pop. If you don't want to use delta, you can literally put pop on there. Pretty sure that's one of the custom quotes. So here's probability of touching, probability of being out of the money, probability of being in the money. Pretty sure we had probability of profit too. Nope. Just probability of touching in the money and out of the money. Um, Trading View, no, not Trading View, Tasty Trade, they have pop, but probability of touching is good enough, or just probability of being in the money or out of the money. They're the same thing. So you can load that column, but delta is going to be just as good if you don't have that column. You don't have to stress on it. Now, I don't know the criteria that they're using to develop these bullseye trade ideas. If they saw something in the candles and then tied that back to options and decided that this was the right option that they wanted to trade, I don't know. You'd have to watch some videos on bullseye. But the idea is if you're looking for options activity, that's a good place to go. The problem is in general, options information is not going to give you market direction. It doesn't work that way. Unless the data coming in is glaringly obvious, it's not going to work that way. So you can't just run scans and expect all day, every day, for options information to give you stock direction. And if you randomly decide that you want to trade Netflix, Amazon, Google, whatever, you can't just open up their options chain and expect to see in the options data where the market is telling us the stock is going to go. And if you can, that doesn't mean that they're right. I can probably spot where Amazon's options are pointing us. That doesn't mean that Amazon's actually going to do that because the options market gets it wrong just like everybody else. So it's a common misconception that the answer to what direction is the stock going to go is hidden in the options data, but it is not hidden in there. You get places like Spot Gamma, Volland, Mentor Q. They can put together a lot of the dealer hedging dynamics for these individual companies. And from that, can give you really strong support and resistance levels, areas that may act as gravity if we get close to them because of the dealer dynamics and the way that they're going to hedge. But you can't see that information in the options chain. You have to have one of those platforms. You got to spend the money, and they're not cheap. They're also confusing as really confusing. Now, Spot Gamma, not bad. Mentor Q, also not bad. They've really, I don't want to say dumbed it down, but they've made it really easy to use. Really easy. You get something like Volland, and it's madness. Like, no idea what the heck that thing is trying to tell you. And you'd need a degree in science to figure it out. But they're expensive products. And even then, it's only going to tell you what things are at right now. So I can look at Amazon 40 days out on Spot Gamma, and it may tell us that we should short this and run it into the dirt because that's what the dealer hedging dynamics tell us to do right now. And yet, by the end of the week, some news can come out and the dealers can change all of their positioning around. And now suddenly everybody's bullish on it. And that old analysis is no longer valid. So even if you have access to those tools and you can suss out what it's trying to tell us directionally, things can still change because these are swing trades with 45 days, 65 days, and they will not sit there idle by, watch this thing just crash and burn with their position in it. They will constantly hedge and they'll move out of it and get into something that's winning. So I don't jump up and down telling people you should go get a subscription to these places. It's great if you have one, but if you don't have it, you're fine. Start with something like Trading Ticks because it will give you a good starting point, and then follow that down. Nike popped up in there, right? We got a bullseye Nike trade for the 60 strike on May 16th. Well, that's a little short, but okay. May 16, 60 strike, call buy. So it's in the money call. 315 if we want to split the mid. It's got, reasonable open interest. At least it's in the thousands. And why am I on 59? We want 60. All right. There's 60. A lot more open interest. I like that better. 21,000, over 5,000 traded today. 85 delta. Yeah, that's not bad. And we got a good starting point, right? And we can take something like that and add to it. Maybe I look at this and I say, well, $225. Eh, I don't want to risk $225. Maybe I'll turn it into a call debit spread, right? So we take this trade and turn it into a debit, and now we're risking $80. Much better. I still started with the idea that Nike had a call out, that it's got elevated volume on that 60 strike, that it's being interpreted as bullish, and they're recommending buying a call on this. We didn't even look at the stock chart. So, of course, we could look at that. On the bare minimum, if they're recommending a 60 strike, they're suggesting that the stock will close above 60. How much above 60? Well, it's a $2 option, right? At least it was before we split the mid. This would need to close at 62.25, whatever, split the mid, for us to be at break even. So it needs that or more to be a profitable trade at expiration. Now that we've split the mid like this, we turn it into a spread. We only need $60.80 to be above the break even. Now here's the rub. This looks like a good trade, by the way, right? It looks good. It's absolutely not a good trade. Here's the problem. This trade is worth $1 in total, right? So spread is $1 wide. We have to pay 80 cents for it. The entire trade combined will equal $1. If we pay 80 to get in, that only leaves us 20 cents of profit that we can make in that trade. We don't want to risk 80 cents to make 20 cents. It's just not a good idea, right? So if we did turn it into a spread to reduce our risk so that we don't have to pay 200 and whatever that price was on the mid, we made it a cheaper trade, a quote safer trade, because we reduced our loss from 2 something to 80, but we capped our gains, and now the whole trade combined can't make more than $20. It's not worth it. So when you go to get into a trade, you got to ask, is it worth it? How do you evaluate if it's worth it? Some sliding scale of value based on probability of profit and how much risk versus how much reward. That trade has an 85, 90% chance of being profitable. I mean, that sounds really good, right? Even if it is $20. Not good enough for me. It doesn't work for me. That's as bad as those out of the money trades where, we're selling an option to open and we're looking at a 90% chance of winning that way. There's additional risks we have to think about. It's in the money, close to expiration. We could get assigned, and then we'd have to exercise our side. Just turns into a big old mess, right? Even that long call that's posted in there, that 60 with 2 days to expiration, you're taking some pretty good risk if you just straight up buy that 60 strike because you're holding on to an in the money option. One, you have to close that by expiration. Two, you could get assigned. Somebody could exercise their right. At expiration, if you're in the money, you're going to get it. Now, as the buyer, you get the rights, and I doubt you're going to exercise it yourself. So really, it's just at expiration that your threat is there. Still, are you going to travel? Are you going to be home that day? I've had trades where I was on the interstate on Friday and lost cell service an hour and a half before market closed. I thought, well, I had time because it's an hour and a half. And then I got into traffic because they were working on the interstate. I couldn't turn around and go back, and I couldn't go forward. It's those little things that you remember for the rest of your life. It happened to me with Tilray, a pot stock, not long after this thing IPO'd, no less. Right? It was months old. It was really new. So way back here, right, in the shenanigans days. And that happened to me. So you don't want to get in that situation, right? I can't believe that thing's a penny stock now, but you know, whatever. So when it comes to identifying if something is a good options trade or a bad options trade, start with, is it a good option or not? Go through the list. It has weeklies, it has liquidity, open interest, volume, activity, the strike widths. Once you've identified or validated that it is liquid, then you can start trying to determine if you should even trade it or not. Just keep in mind that, contrary to popular opinion, the you don't want to use the options to tell you what direction the stock is going to go. You really don't want to use it that way. Don't put the cart in front of the horse. So you want to have a stock idea, a directional play or a non-directional play. If you think we're going to go sideways, like Riot, if if you think it's going to stay between 8 and 10, trade that, right? That's an iron condor at the bare minimum. Or if you want to trade it directional, then buy a put, buy a call, you can go that route. But if you think you can just go into the options and identify a market direction from there with a high win rate, no, that's not how it's going to work. So you don't have to worry about scanning for them. If you're trying to find, you know, calls or puts that you should trade based on some scanning criteria, what exactly would that criteria be, right? Because there isn't anything out there that is going to randomly pop up and say, hey, you see this 10 strike right there? All this volume being traded today compared to all of its peers, that strike really stands out, that 10 strike. Yeah, you should totally buy that call. You'll find things that'll tell you to do that, but why? Just like that Nike position that we saw, why? You think this stock is actually going to go up and put that 10 in the money? Or is it just some algo driven feed that says, yep, that 10 has unusual trade activity, over 1,000 contracts traded, and all of its peers aren't getting anything, and it's cheap 37 days out? You should totally buy that option. So now that we've eliminated what bad is and what good is, and we want to start focusing on strategies, tactics, there are popular strategies and rules for those strategies. You can break the rules if you want to. Um, they're not set in stone, they're just guidance. But a common rule of thumb, for an example, is that you don't want to buy iron condors. You can, but you don't want to. So, most people, if you hear them saying that they're trading an iron condor, it's just implied that they sold it to open. An iron condor is just two verticals. So once you learn how to trade a vertical, you can trade an iron condor. Butterflies are just verticals stacked on top of each other. So if you learn to trade a vertical, you could trade a butterfly. Now, options trading can be done for speculation, for income protection, or share portfolio accumulation. But we can do it discretionary, systematic, quantitative, fundamental, or technical. We can use any of those trading styles to trade the options. And with that, we can do algorithmic arbitrage, which I got to say, um, nowadays, there's no room for retail in arbitrage. That's my opinion. And unless somebody can prove to me the edge, I think that's dead for retail. There's just nothing left. Back in the day, though, that's what everybody was playing. The difference between the bid ask spread, that arbitrage is what Susquehanna and BlackRock and all those guys were making their money on. A lot of them still are, but that's for them, right? They're making book. Well, I'm not trying to make book. So arbitrage, I don't feel like that's a retail play anymore. But we got the basis trade, the carry trade, the contrarian trade, dispersion trades, directional trades, of course, event driven trades, what like earnings, drug trials, announcements, investor day conferences. We got the global macro trades, momentum trades, mean reversion, pairs, quantitative, sector, theta, thematic, trend following, volatility plays. All of those can be done in options, which is why it gets confusing for new options traders when they say, I just want to trade options. I want to trade a call or a put. Cool. What's your approach? You looking at the stock chart? You watching the news? What are you doing? What do you want to do? Because once you decide what you want to do, then we start putting the rules together on how to do it. There's videos on the bullish bears where I lay out some rules for how far out in time to go, what strikes to choose, what delta to pick, how much credit you need, or how much you should pay in profit. And those are guidelines to help you start the process. But they're not the solution to everything. And I was talking to somebody today about premium trades. It's a real big topic, right? Everybody wants to do premium trades, selling options and making money on it. It's awesome, mainly because you don't need any technical analysis to do it. You can be brand new to trading, can't read a candle chart at all, and yet you can trade premium trades. And you'll have a high win rate too. If you follow the rules, you can win 85 to 90% of the time. It sounds fantastic, right? Almost too good to be true. And the rules are really simple. What's not to like? No analysis skills, win 90% of the time. You can do it as a part-time thing while you have a full-time job. It's perfect, except that it ain't. So Tasty Trades has some rules. I've never been able to actually find their rules in the real world, but they have some. They will tell you to trade out of the money somewhere around a 20 to 25 delta. We'll just use this 29, 21. I think that's a little too close to the money, but whatever. We'll use it. They'll tell you to grab a spread that close, and it has to have, say, one third the width of this position. It's a $5 wide trade, so you just get the calculator out. right? You really don't need to do it that way, but if you want to nerd out and get it to the penny, it's $5 divided by 3. This position should offer me $1.66. If it is not offering me that much money, then this is not a good trade. Now, that's Tasty Trade's rules, and I've never found it in the real world. I'm sure there's going to be examples once in a while where you could find it, but I never found it. So I took that and I adjusted things a little bit. Instead of using a specific delta and then hoping to find the amount of credit that I'm looking for, I start building the spread and I look for the credit that I'm looking for, 66. I still didn't find it, and look how close I am to the money now. I got a 170, 175, and we're at 165 right now. So I'm pretty close to the money, and I still don't have that credit. This is not a good trade. I don't want to be that close for this much credit. Nope, I'm done. I'm gonna move on. This isn't even my approach. This is Tasty's approach that I modified. My approach doesn't use this at all, right? But if we want to use Tasty's and stick to their logic, that's a good way to do it. And you'll still find that you're handicapped. You go to put one on, like we just did in Google, and you can't find one. Or you find it and it's so close to the money that you think, I don't want that. I don't like it. You don't like it, you don't get it, you move on to another one. One of the reasons that we're having a hard time finding it is because these strikes are $5 wide, and there's not a lot of wiggle room for us. Yeah, there's nothing here, huh? So there's our 166, but again, we're right up against the money. No good. Might as well do it my way if we're going to get that close to the money, and that's the way I trade these premium trades. So instead of going, oh, I left out some conditions, they will tell you to run a scan and find the stuff with the highest implied volatility because that stuff will be more juicy in its options. I think that's the craziest thing in the world to tell somebody to do. So you can see the really high implied volatility here on Apple, and it wasn't earnings volatility, right? Because earnings volatility is completely different. It's fake. You don't want to try to trade that as a high vol probability. This is just a high vol situation right there. Perfect. Awesome. They'll tell you run a scan and find things with high volatility just like this. And that is going to have really expensive options. And then you can sell those from really far out of the money, and it's juicy enough that you actually get to make money on it. That's madness. It's crazy. So worst thing in the world that you would ever want to tell somebody to do, because volatility is movement. It's just a fancy nerd word. It's science talk for movement. So if I'm going to put on a trade and I need price to not move, why would I find something that has the highest probability of making a move? Implied volatility is promised movement. Just get rid of the nerd words. It's promising it's going to make a move. And you're going to put on a trade that says, I bet you don't move. That's not going to work out too well. And historically, it doesn't work out too well. You see the size of these candles in that high volatility? These candles are huge. If you're wrong, you're going to get annihilated. You can't get far enough away, it'll run you over. And that's one of the benefits that they hype up, right? Is that, oh, just get far enough out of the money. It won't hit you way out there. Wink, wink. You'll be fine. And then of course it hits you anyways because it has a high implied volatility. So the reason they tell you to hunt for those high volatility products is because of the money. Okay. That takes us back to Tasty Trades. And what Tasty was saying is you need to get at least some profit and you need a line in the sand that says, well, how much are you willing to accept for the risk that you're about to take? Is 1/3 the width enough? I don't have 1/3 here, but I'm close. Tasty says, yeah, 1/3 is enough. And if this had a high enough implied volatility, I would have found 1/3 farther out of the money. So I can get farther away, still get my 1/3, and I'm gold. That's their metrics, right? And that if you're not getting enough money for the trade, you don't want to do it because it does have a win loss ratio. And if you do the math, you can win 90% of the time and lose 10% of the time and still be profitable if you're getting enough money for it. But if you're not getting enough money for it, those 10 losses will wipe out 90% of your wins and more money on top of that, and you'll be in the hole. So you need more money when you make a trade of these kind. If you're doing these premium trades, if you sell them too cheap, it won't matter that you win 90% of the time. My solution fixes all of that. We don't need to hunt for something with high IV, and it doesn't matter if it has low IV. Low IV says it has no expectations of making big moves. Perfect. That's exactly what I want to trade. Unfortunately, low IV also means there's no money in the options. There's no premium there. Well, that sucks. I don't want to sell something that doesn't have any money on it, right? It needs to decay and I need to make money. But if you trade something at the money, whether its IV is high or not, you should get half the width of the spread. It's one of the quickest ways to identify if it's a decent trade or a fair trade or if they're trying to screw you over. If you build the trade and you don't see half the width, it's not a fair trade. Don't take it. And you can trade it, you can build it long or short. It doesn't matter, right? Here's a call spread, a put spread, long, 240. It's not 250. That's not what I'm looking for. And it doesn't matter that I tried to buy it. We can flip it around instead and do it that way. It still shows 240, right? It doesn't matter if I tried to buy it or I tried to sell it. It's supposed to say 250. It's the quickest way to show, am I getting a fair price here? So at the money, preferably one leg in the money and one leg out of the money. That way you're straddling the money and it should be half the width of the spread. If it is, you've got a fairly priced options position. It doesn't mean you're going to win. By all means, no. It's just telling you you're not getting screwed in the options price. That's a good start. It's a really good start because it's where a lot of traders fail, anyways. They paid up for something that they shouldn't have paid up for. This trade will win or lose based on what the stock does. You're not going to be handicapped because it didn't have enough volatility or it had too much. You won't be handicapped because the delta was right or it wasn't right, or the implied vol was good or it wasn't good. Doesn't matter about the theta, the gamma, none of it matters. This trade will be judged on whether or not you got the direction right. That's it. And if you're wrong, you'll know you're wrong because you built it at the money, right? So when I hit confirm and send, this is going to tell me my break even 212.60. Since I have a short put spread here, I would want this to be under the market and stay under the market. 212.60. I need the market to run up and put this just like that. Let's throw it over here. Make it visual. Oh, look at all this stuff. Get out of there. Get. There's that position right there. I need the market to run up and keep that break even on the left side of price. So right now the Stock is right there. That's where Apple is trading. And we need it above that right there. So we need to keep going up. If I'm wrong and this continues to fall, I can close the trade out. I don't have to worry about the same conditions that they do when they build it really far out of the money. Their concern is usually, well, gee, I don't know if I should close it or not because it's still a winning trade. What I mean by that, if you haven't traded one of those, let's just build one here real quick. We'll make it $5 wide. So here is what is offered on the internet all the time. They love these trades. This is the break even. So as long as Apple does not fall below that level, you're good. Sounds great, right? I'll go long. Apple just stays above that level. Bob's your uncle, and I get to make $37. Now, they'll argue and say, I know it's only $37, but look, your chances of winning is like 83% in this trade. I think it was 83. 92. You got a 92% chance of winning this trade. It's fantastic. So it doesn't matter that you're only going to get 37 cents because, well, you could just trade this 1,000 times, right? That's what they're going to tell you. Heck, you could just size up and put, 50 of them on. Who cares? The problem is it still will lose 8% of the time. And if you have 37 here, let's just bump it up and say you actually had 40. You got 40 cents for that trade. You're risking $4.60. Why? Because it's a $5 trade. If we have 40 cents, we're missing 460. If 40 is our profit, then our risk is the other side. Can I lose $460 9 times and still be able to have money left from the 92 times that I made $40? Maybe. Maybe. And we can get the calculator out and add that. But here's the rub. When people trade these, they don't trade them for 40 cents. They put them on and then they target like 50% profit and they close them. You'll hear it all the time if you've ever seen one of those YouTube videos. They'll say, okay, we got the trade on. We're going to aim for 50% profit. We're going to close it out. So instead of 40, we're really only going to get 20. And depending on your broker, you got to pay commissions out of those $20 that you did make. So now we've risked $460 for a chance to make 20 after commissions, maybe 16, $15. If you lose 9 times $460, you've lost all the profit and you're in the hole. It won't cover the losses, right? The profits are not enough money. So I don't like this kind of trade. And they say it's really good because, well, what's the likelihood that Apple's going to go all the way down there and break and fall? I mean, it's really low. There's a 90% chance that Apple won't do that. But you don't know if you should close the trade. So if we start to fall, this trade is going to go negative immediately. When do you close this? Because you don't want max loss, right? Maybe you only want to lose twice your credit. You collected 40. So if the risk gets to 80, maybe you'll close it there. How far would that have to be before we start to see loss? So we can add price slices. We've got one here at the current price, 211.40. And I can take control of the stock price, right? Because it's magic. Let's drop the market by $1. And our P&L right now, we're actually up $2.22. Yay! So let's drop the market $1 from 211 to two from 211.5 to 210.5. Now the trade is down $57, 57 cents. All right. Hey, it's not bad, right? We're good. It's okay. And let's knock a few days off of this. So now it's June 1st. We've slipped a dollar. Hey, we're good. Time went by. It's all right. Let's take $10 off. Now Apple's at $200.50. And now we're down P&L 56. 80 is our number for getting out. So we're still good, right? We're still good. How about 190? Our break even is here, 184.5. Well, that put us at minus 250. So that was too far. 195. We're still too deep. You see how fast we're so in the hole already. And we're just messing with numbers, but if time goes by and the stock price falls, you don't know when to get out. You're at 130, 140, 150 negative, and it can go to 500. You don't really want to lose $500. You will close this loser early because it's what we all do. At what point do you close it? If you close it really fast at, say, minus 60, what you'll find is that it was just a minor pullback and the stock kept rising and you should never have closed it. If you don't close it at a minus 60, because all these minor pullbacks, they could have cost you that and you'd have been out. And then it just kept going higher and you'd say, why did I close it? I should have held it. But if you don't close it, it's going to go from a minus 60 to a minus 260 overnight. And now you're sitting there looking at a massive loss. You don't know when to close those things. And it's not your fault. It's not my fault. Nobody knows when to close this because there's no good way to do it. So my solution to that problem was just don't trade those. If I can't find an acceptable way to get the heck out of it, why mess with it at all? Just leave it alone. Find something else to trade. So if we build them at the money and we know what the break even is, because we can either calculate it for ourselves or if you're using Thinkorswim, it'll show you when you hit confirm and send. There's our break even line right there. Now this one's requiring that the Apple actually goes somewhere, right? We're pretty deep here. The stock price, we got to unlock that. There we go. Now we're back to normal. This is where the current market is. This is our break even. We got full control of this trade. If it starts to lose, if price starts to fade back, we can evaluate it from a stock position point of view and determine we don't like our odds and get out with a small hand slap. Maybe we lose $5, $10, $15. Maybe we win $5, $10, $15. Who cares? It's a small trade. We move on. But if it works, if we go in the money and we only need a few dollars, right? We're talking about from 211 to 215.5, $4.50. We can get max profit if we move that far and just stay there. We don't even have to keep running. Just go to there. That's it. And we'll make max profit from that. As time goes by, you'll get paid like it's a theta trade. It's craziest stuff. They will pay you to stay in the trade if you're on the right side of that break even, so that each day you're in it, you're making more money. And price does not need to move. So this at the money trade, in my opinion, is a much better way to trade premium trades. You can, one, you get a lot more money, which means when you are wrong, you've made money. You can pay for the loss and you still got money left over. But two, you know what the loser looks like. In that other one that was really far out of the money, you have no idea when to close that damn thing. So you never know what the loser is. If you should close, you shouldn't close. You no idea. The reason that it's not really popular is because you lose the promise that you don't need any technical analysis whatsoever, right? That's one of the major selling points is, hey, do the way out of the money trade and you can do it even with no technical analysis whatsoever. I mean eh, that's a really nice promise. It's hard to beat that. But this has a 50-50 shot, right? That's a coin toss. I mean, all things considered, that's not bad. 50-50. I'll take my odds because all I got to do is bump the odds in my favor just a little bit. If I can get it from a 50 to a 60, a 70. So if we do it against resistance or against support, if we do it against a major moving average, right, we can increase our odds just from those things right there. Do it after it's made a big, crazy, wild move because markets generally stall after they make a big, crazy, wild move. Anything that we can do to increase our edge will get us above that 50% and put the odds in our favor. So you can literally just go down the watch list, and as long as it's a watch list of liquidity, you could put a trade on in every single one of those, whether it's sideways, high momentum, low momentum, trend, no trend, it doesn't matter. There's a few things that do matter though. Earnings, don't do these in front of earnings. Don't do them in front of dividend. The list should already have filtered out anything that is trash, but don't do them on things that are trash. So out of this list, pretty common ones are going to be the momentum trades, the mean reversion, theta, trend, and volatility. Those are pretty common, right? Earnings trades, everybody loves those. Those are volatility trades for the, um, well, let's rephrase that for a little bit here. Earnings trades for newer traders is speculation trades where they buy a call or a put. More experienced traders trade earnings trades by selling the options. It's not about which is better because they're both really dangerous. They're earnings trades. They're both really dangerous. But when it does come to volatility trades, most common volatility trades that I can think of are earnings volatility. People put on a trade expecting volatility to get crushed, right? And then earnings comes in, it crushes the volatility. The thing you sold lost value really fast, and you get out of it. That's the way it's supposed to work. And we can see that, right? Earnings hit, volatility got crushed. Yay. The problem is it's artificial volatility, and the options on earnings don't decay the way that this volatility suggests that they should. And so you'll sell something for earnings, say you sold a call and price fell, it did exactly what you expected it to do, and your option barely made any money at all. And it didn't decay. So now you're stuck looking at the clock, waiting for that thing to lose value as time goes by rather than having lost value because volatility dropped. Other volatility trades are calendars. They're more popular, at least if you get away from the earnings trash. That idea is looking at the volatility on the side. Calendars, if you're unfamiliar, trade a short option close to expiration or closer, and then buy one farther away. Well, volatility is a lot like price. So, what's the old adage when it comes to stocks? Buy low, sell high. Everybody's got the t shirt, the bumper sticker, right? The hat. Volatility would be the same way. Sell high, buy low. So, what we want to find is options in the front end with a high implied volatility that we can sell, and then farther out with a lower implied volatility that we can buy. Buy low, sell high. It's the same logic, right? And if you do that in a calendar and you actually trade it as a calendar, meaning you keep the trade together until it's time to close it, then you close both all at once, the trade will function based on volatility, which is really cool. If you disconnect those two and you just have a long far out and a short closer in, and you keep closing the short, selling another one, closing it, selling another one, closing it, selling another one, well, now you're just running a theta trade or a premium trade. It's not a theta trade. I misspoke. A premium trade developed like a calendar or a diagonal. Same difference. There's a lot of things out there that make people believe there's more information inside this options chain. And I've seen some people that make pretty big statements. How they looked at options on, say, Apple, for an example, and the options told them that Apple was going to go to 220 by the middle of June, and they knew it because they could see it right here in the options chain. And so they went ahead and they traded whatever because they saw that here. Nope. I call BS on that. Mm-mm. There is information in here that can help you with that. It would be down here. We can look at open interest for an example. Let's try to clean this up a little bit. And we can pick an expiration for that open interest. Here we've got pretty much everything for this year. We'll just add December onto that. That's 2025 showing there. And we can try to identify, hey, where's the highest amount of open interest? Right there. June. Okay. So Apple 200 by June. Okay. Now that's the average. We can do just calls, just puts, only the stuff that's out of the money, everything we've got, which breaks it down on both sides at once. So we can find high implied volatility, and that tells us where traders are carrying trades. It gives us insight into where they are. It doesn't give us bullish or bearish bias. It just tells us, hey, where are they at? So then we can go in and find them like this 23,500. That's a really big position in Apple. 65 days out. It's at a big round number, 250. And it just had another 2,400 contracts traded today. Now we can find that and start digging into it, do research, and see, did they buy these or are they beginning to unwind this position? How long has this been here? We can figure that out too. We can just straight up chart this thing, right? Copy that, put it out on a chart. Let's just use the quick chart here. Come on, Thinkorswim, you can do it. Looks like they started really building that position out April 2nd. And then they liquidated some of that position on the 14th, and now they're adding into it again a little bit. So we can do research on it and we can dig around and try to figure out what they're doing to a degree, right? It still doesn't give us a lot of confidence on what's Apple going to do because it was only one expiration. It was only the calls. I didn't look at the puts. We didn't go up and down the options chain and look at all the other information, which we would need to do if we were going to use the options to try to figure out where Apple is going. So you really want to give up on that idea unless you've got something like Trading Ticks, Spot Gamma, Vol Land, something, right? Instead, lean on your technical analysis, your charts, the candles, the earnings backdrop, economic events. Lean on all of that, identify a direction, and then trade the trade. So that leads us to what expiration, what strikes? How do I know what strikes? How do I know what expiration? There's no wrong way to go, but with this, I do like to focus on what I don't want. Eliminating things that we don't want is a really good way to narrow the field. So if I'm looking at Apple and I've decided that I'm bullish, I want to take Apple long. Now I need to figure out what expiration and then what strike. And do I want to go long with puts or do I want to go long with calls? I don't know this before I start the trade, right? Because that's making assumptions. I would want to figure that out when I get here. If you do have a checklist, you can just do that. Like maybe you always buy calls. Great, always buy calls, right? Maybe you always sell puts. Fine, do that. You can have a checklist and go that route. Or you can just poke your head in, take a look around, and see what is offering you the best opportunity. So, time. To evaluate time, where's the next earnings? Late July, basically the 1st of August. All right. So I either need to be in front of that or I got to jump completely over it. A good starting point. August is 93 days out. Well, I really don't want a 93-day trade. Let's go in front. That's July 18th. That works. It was at the end of July, right? This is like more than 2 weeks away from that. It's perfect. So anything in front of this from July 18th all the way up to May 30th, anything in the middle of this is fine. Cool. Now we got a starting point. Where's the liquidity at between May 30th and June 18th? We would have to figure that out, right? Look at the volume today, calls and puts. And is there anything that really stands out while I'm poking around in here? That 23 is on both sides, by the way. It's on the puts and it's on the calls. So they opened up like one of those multiple positions. And even at this point, we wouldn't know, what are they doing with it? If that's all of their position, they could have more in different expirations. Monthlies generally have more liquidity. So if we look at this one that's 44 days out, sure, it has some trades. But we can see these puts are seriously neglected. And the calls, they're anemic. There's not a lot of activity here. It's okay if we didn't have anything else, we'd make it work. But this is it's kind of embarrassing, really. So we don't want the 44 days. 65s still look really good. And by 65, I mean 65 days to expiration. Look at the June. This is also a monthly. Lots of volume, lots of open interest, calls and the puts. Calls definitely more than puts, but still, both sides look pretty good. Bid ask spread, it's not completely out of line. We still have $5 wide strikes on both of these. So if I was looking at June or July monthly, it's $5 either way. I'm not gaining anything by choosing one or the other. All right. So both those monthlies are on the table, but that 44, no. So now we can look at these last few. We have three left. This is just a weekly, and it has a little bit of call volume, really no put volume. $5 wide still. So we're not gaining anything. The bid ask is getting worse. It's $10 wide now. It was 5 on the other one. So it's a little more sloppy. These calls are looking pretty decent, but now we're like 23 days to expiration. We've shortened up the game a lot, and we want to be out of this trade around the 10-day window, right? We can hold it less than that, but you really you want to get in the habit of getting out of a swing trade before it gets into that last 10 days. That's when your P&L within the options trade itself really gets violent, and it can go from a winner to a loser fast. So if you get in the habit of getting out before it gets below 10 days to expiration, you won't have as much stress and chaotic options pricing. So this doesn't leave us much room. It's like 13 days. It's all right. It's fine. But we also have to consider if we're going to sell to open or buy to open. Do I want to sell something 23 days to expiration? Is there any juice left for that squeeze? All right. If I'm going to go that short, probably going to want to buy instead of sell. And do I want to buy or sell? And then this one, way too close to expiration, but it does have a lot of liquidity. Calls look better than puts, which we've been seeing anyways. And it has some matching positions, just like the other one. It's just in a different spot. 220, 190. It's a nice 30-point wide spread. That was today. That's good volume on that. So for me, this close to expiration, I need a momentum signal or trend continuation signal. I wouldn't want to do it if I'm just, how do I say it a different way? So when you're looking at the stock, and we've decided we're going to go long Apple, right? We've already decided that. If you're looking at the stock and you think, yeah, I bet it doesn't fall below that. Well, that doesn't necessarily mean you're bullish. It didn't imply any momentum whatsoever. It's not even discussing trend. It just says, yeah, I bet we won't fall below that level. All right. I can take a long on that, but I'm not going to use a short dated option unless there's actually something in here that says we have momentum or we have trend or hey, this thing is moving. Now I'm willing to take a short dated trade because it's going somewhere. So when you're trying to figure out your days to expiration and you've got your bias long, short, sideways, if you don't have momentum already in that trade, you probably don't want to go too short. So we'll back out. The two monthlies really did look the best. 37 if I'm buying, or the 65 if I'm selling puts or buying calls, because both of those would be a long play. And funny enough, we can do both. You can sell some puts and use that risk to buy some calls or to help finance those calls. Both trades can lose, by the way, so it's not like you're protecting one with the other or anything like that. Nope, they can both lose. If the stock was to fall, for an example, both my trades would lose. So the idea is there's no magic here, right? We're just moving through a process. What's the bid ask spread? How wide are the strikes? How much time do I have? Am I willing to risk that much money? And if not, what am I going to do for some kind of exit? Do I use a stop? Maybe a delta alert, right? Some criteria that says I need to get out of the trade. and you just work on the rules until you've got everything written out, formulating exactly what you're supposed to do, and then you do it. Now, when it comes to P&L, uh, profit targets on options is a little weird, and you can't treat it like a stock trade when they bring in risk to reward, for an example. If you are losing options trades frequently and you're buying, lower your profit target. You'll win more often. And it's not because you're suddenly getting the direction right, it's because you're getting out faster before the market had time to go against you. That's funny. So, what I tell people when they're just getting into options is after you've got your strategy, you've developed your play, and you go to execute it, keep your profit targets on the slim side starting out, maybe 15 to 25%. And yeah, you will leave money behind. That's frustrating. And yes, you could have made more if you'd stayed in longer, and you're risking more than you're making. All that's true. But you will win more frequently starting out. So it helps with the confidence issue. It helps with, the idea that does the strategy even work? If you've got a very low profit target, 15 to 25%, and you still can't hit winning trades, something's wrong with the strategy. Or you're really bad at picking direction. Because we can all get direction wrong. But to consistently lose again and again and again and again, something should stand out, right, as being seriously wrong. I had all this written out when it comes to different strategies. And in the Bullish Bears videos, I explain criteria and numbers and levels and expirations, how to identify, and I did them in a systematic way, tick step by step, for just that reason. So that we can walk through it, or a trader can listen to it and follow the steps one at a time, kind of work through the system. I'm looking through my notes here. I thought I had one that would be really good. I've got too many discords. Oh yeah. So here's some good ideas when it comes to options trades. Tasty Trades has done tons and tons and tons of work and research and back testing when it comes to trades and spreads and what expirations to use. So I started a Discord and I grabbed those videos, and then I would watch the video and I would take pictures and write out notes. That way, when I come in and I could look and say, all right, from a pairs trading point of view, what's the optimal expiration, or what's the optimal delta to use? How far out of the money, right? So it's pretty handy. It's a good way to go. I found videos to explain different things on the platform, like that P50. That was pretty new when Tasty Trades first came out with it. Um, for debit spreads, here's theirs: 45 days to expiration, low IVR, one strike in the money, one or two out of the money, and then go more than one strike wide. That's one of their criteria that they lean on when it comes to debit verticals, which they don't even like debit verticals, right? Buy to open verticals. Sell to open verticals, that's more their style. 45 days to expiration, high IVR, 30 to 35 on the short side, 20 to 25 on the long side, not higher than 35, collect near one third the width, close near 50% profit. And if you are in a spread that is losing, look to add a spread off of the other side. Don't mess with the one that's losing. Focus on adding another trade to help offset that loser. So, suppose a call credit spread is losing, you can open a put credit spread to offset the negative impact of the loss, for an example. Right? Hopefully, I didn't lose you on that. Now, I get it. One of the questions that I get asked when I show something like this is, "Oh, is that a Discord that I can join?" No, I've got a ton of Discords. Most of them are private, and I can't keep track of people that are going in and out. We all know that Discord's got a ton of scammers. So once I start putting share links out there and people joining, and it just becomes a mess, and I got to filter out who should be there and who shouldn't. But doing something like this is not uh, special, right? I don't have any special skills that gave me the ability to do this that you can't also do it. You can grab a video off of YouTube, watch it, and write down the notes. That's exactly what I did here, right? And again, these aren't even my strategies, these are tasty trades, but it gives you an idea as a starting point, and then you can evaluate that strategy, compare it to your own, or maybe build one of your own that uses some of that logic. Then there's places like Options Omega where you can backtest these strategies and see if they're profitable strategies or not. They really do have some good videos. I got to give them credit for that. And they've done a extensive amount of research over the years. Yeah, this was a really good one. They were discussing how big is big, right? When people say, "Oh, wow, that stock made a big move." Well, how big is big? And how far does it have to go before you start to consider that it may mean revert, go back the other direction? Should you fade the gap? If you want to watch the video for yourself, I'm pretty sure you could just Google fade the gap, but here's the link. Hopefully the link still works. They did a system-wide YouTube edit a while back, and they changed all their videos from Tasty Trades to Tasty Live. So if that doesn't work, that's probably why. And you'll just want to search for Tasty Live Fade the Gap, and that should help you find what you're looking for. But they've got videos on every topic imaginable: days to expiration, optionality, I mean, just on down the list. Really good stuff. Some important criteria comes in along the way too, like how wide a position should be. And at some point, does going wide not have the desired benefit? If you think about a butterfly, for an example, trading them really narrow is going to have a very low win rate. It's not a surprise, right? You're going to lose a lot if you try to do this because you've got this very narrow window, and you're saying, I think that the stock price is going to close in that window 37 days from now. Come on, man. That's That's going to be really hard to do. But if you make the window bigger, your chances of winning go up. And so Tasty Trade did some work on this logic and said, okay, if our chances go up because we made the spread wider, is there a point where so wide becomes too wide and you're just not getting the same benefit anymore? And then, of course, how much money did you have to pay to get that higher win rate? And is it worth it? So, a pretty good video. Um, Spoiler alert, it's like $10, by the way. If you're dealing with a $1 wide or maybe a $2.50 wide product, then $10 is as wide as the benefit goes. If you're dealing with something that's already a $10 wide product, I don't remember their answer to that, but obviously it's going to be bigger. And if you guys got options questions, you can always throw them in the chat, because when it comes to talking about options trades, not knowing where the audience is, makes it a little difficult on, well, what topic should we hit on? Because there's, of course, so many aspects to trading them. There is the idea that we want to work the order. This was in the chat earlier this week. The idea that somebody was using uh, a market order because their argument was, well, if I try to use the limit order, how do they say it? It was like it was putting it. They thought if they used the limit order, they would always pay the ask, or that they would always get the bid. And they thought that it would be better if they market ordered in so that maybe they would get somewhere in the middle if they were lucky. I understand why they may have thought that, but you choose what the number is. And if you want lower than that, you can go lower than that. Right. So if I try to buy this call, let's get into something that's a little more reasonable. The SPX options are crazy. If I try to buy a call and it says that it's $3 and $2.72, I can put in 260 if I want to. It doesn't mean I'm going to fill, but I could try to work that order. They're not going to tell me no. So just because you see a price here doesn't mean that's the price you have to pay. You can haggle and negotiate, especially if it's a wider market. You know, SPY is pretty slim, 3 pennies, give or take, and it's constantly updating and moving. So there's not a lot of room for you, no arbitrage in there. But if you're trading something a little more illiquid, there could be plenty of room for you to haggle and negotiate and try to get a better price. And if you're going to trade multiple contracts, try one first all by itself and get a feel for the price. Now, that's something that you kind of pick up over the years with experience. But this is why you would want to do it. Say I got the idea that I want 10 SPY calls, and I go in and I try to buy 10 SPY calls, and they show me a price, and I lower the price by 2 pennies, which means I think I'm working the order. I'm trying to get it cheaper, and it immediately fills. You guys ever had that when you try to get a trade and it just instantly, immediately fills? You know what that tells you? You paid up. Somebody was very happy to give you that trade. You paid too much, and you did it with all 10 contracts. So if you try it with just one contract and you work the order, this says, for an example, 228's the mid. So if I put in 225 and I hit confirm and it instantly fills, I don't want to sell the other nine or buy the other nine at that price. I want to try to go even lower. Maybe I can buy one for 220, 1220 instead. Right. So if you're going to buy a bunch of contracts, work the order with a single contract first just to get an idea of where the market is. And if it hasn't been traded in a little while, if you're looking at the number and the number hasn't changed and it hasn't changed, it hasn't changed, then that bid ask is off because there hasn't been a trade in a while. It needs to update. And when a new trade comes in, it got updated. Otherwise, the machines are just moving the price around like a wave, responding to what's happening above and below. Not the same. So hopefully I've given you guys some food for thought when it comes to options trades, some ideas of what you actually can do versus what they tell you can do out there. There is a lot of opportunity to trade, and there's so many ways that you can do it. It does help if you pick a product and just stick with it for a while. Say verticals, and you just do a vertical over and over and over and over and over until you get really good at it. Because a vertical, as I mentioned earlier, is part of a butterfly, is part of an iron condor. If you learn how to do a vertical, you can do those others. And calendars and diagonals, they're awesome. And you can really get a lot done with them. They're very much like a vertical. They're just using different expirations. So say I buy the 590 5 days out and I sell a 590 2 days out and the whole thing cost me 85 cents. Now this is it's a calendar because the strikes match. And because it's almost at expiration, you don't want the tomatoes? All right. Well, if you're going to be the only one eating tomatoes then, we're having hamburgers for dinner tonight with tomatoes. In my family, I'm known as the person who hates tomatoes. If they're cooked, steamed, not cold, soggy, squishy, I'm really picky about tomatoes. But if they're fresh from the store and they're cold and you slice them thin, I do like them on my hamburgers. Or the little cherry tomatoes, I like those in my salad. But that's it. It is. And you know what? When I built my trading bot, Al, I learned so much about trading and about my own strategy for trading. The things, the criteria that I wanted, the things that I should look for. Teaching that damn bot what I wanted really helped me grow as a trader. Maybe building out this AI will really help you get specific about the things that you want for a trade yourself. I've got a calendar showing here, and I mentioned earlier a calendar is very much a vertical trade. And I wanted to demonstrate that. So I'm going to remove volatility, set it to 0, and you can see how small this trade is right now. It's a very small trade. And we'll move the slices to break even at expiration so that it's that wide. Now, what happens if volatility goes up? I'm going to make it extreme just so that it stands out. But let's add some volatility to this. Hello, Thinkorswim. There we go. And now it's much bigger. The gold lines show where the original break even was. And now we can see the break even is much bigger. And this is very much like a butterfly, right? If we are in the tent, we make money. And if we're out of the tent, we lose money. So this went from 571 to 608. Let's just say 570 to 610. So easy numbers. That was a 40-point wide spread. Now it's a 200-point wide spread. My chances of being in a profitable trade are much greater now because volatility increased. So when it comes to calendar trades, volatility is really your friend. If volatility gets crushed, however, that's a completely different thing, and that's not so good. So instead of adding, we will subtract 30. And that was so small that it just it's gone. There's not even a trade left, right? It wiped it out. We'd have to make it less than that, say maybe 10. Yeah, there we go. There's a tiny bit of the trade left somewhere in there. It's just so broken. So you get the idea, right? The volatility can really screw up your trade. When it comes to a calendar, they are often demonstrated as price trades, but at the end of the day, it has a lot to do with volatility itself. And so, what we want to focus on is the idea that does the front have that lower volatility and does or higher, and does the back have the lower volatility or higher? And as I mentioned earlier, it's just like the stock price that we used to talk about, buy low, sell high. So in the front end, you want to sell high volatility, and in the back end, you want to buy low volatility. If you can't do that, try to make it wider so that you can find the volatility that you need and or change expirations completely. If the dates to expiration are really close together, then you often won't have enough differential in the volatility to make it worth your while. So they can be done if volatility is not an issue. You can still do the trade anyways, but now you're relying more on just price itself. And it is a time based trade. So, think about it. This is the tent, right? And the only way that we'll make money is if price is still in the tent. later on. We can't go somewhere really quick and be profitable. This trade cannot quickly make money. You're stuck here waiting for it day after day after day until it finally becomes profitable. And the line that I hid, because I wanted you guys to focus on the line that you can see right now, is at expiration versus profit along the way. So let's hide that one and highlight this one. So this one is profit along the way. It's that gold line there. And as time goes by, you'll see that that gold line starts to demonstrate our profitability. But the only way the profit is increasing is because time went by, right? If price moves up or if price moves down, our trade will begin to lose money because we won't be at the apex anymore. But we could rise to 600, right? And we're on the edge, but we would still be profitable if time went by. We just have to sit in the trade and let it go by, right? So this is a time-based trade, very much like a butterfly. You can't win butterflies quickly. You have to just sit there and let them play out. And they work better, just like a butterfly, if you are farther out in time to begin with. If you do a calendar and you're doing them really close into the front, they're very difficult to be profitable. You're handicapping your trade. Um, so, how far out you have to go? I mean, I've done them at 5 days. Usually, like on Monday, you have Friday and you have the following Monday. I've done those and it's kind of close, but I mean, it works. But I haven't been able to say on Monday, put on a Wednesday, Friday calendar. I haven't been able to do that. So you got to have some time. If you can go farther out, even better. Something like 1320, right? Or 3042, something spread to it. It's a good trade. Pretty excited about the moves that we saw in the Mag 7. I mean, that's been fantastic. I keep coming back to this growth versus value chart, right? And I've explained this a couple of times, but if you guys weren't here, they're both growth versus value, but the one on the left does a really good job of keeping track of the Mag 7 trades. So when this gets to rip into the upside, you want to be looking for longs in Meta, Apple, Google, Tesla, Nvidia, Microsoft, the Mag 7, the NY Fang crowd. And sure, you can pick and choose between them. You don't have to trade them all. And if you look, I mean, they're not all doing good, right? But collectively, as a group, they're doing all right. And we can see it reflected here. This very sharp move to the upside. The other one here on the right, it's more of a generic growth versus value. The idea with the one on the right is if the broader market in general has more growth names outperforming value names, then it will go up. And my mouse matches on both sides of the chart. So if we look at where the blowout really happened, it's April 2nd. That was right around Liberation Day, wasn't it? So he announces tariffs, the market dumps, growth versus value starts to take off. There's a I don't know if you guys can see it in the stream, but it changed direction there, right? You can see how it really sharp right there. April April 2. Doesn't make sense, right? April 2, that's when the market dumped. Volatility spiked, everybody was freaking out. We had growth accelerating. But the Mag 7 really didn't, not at that point. So it took this one a little while, but the broader market growth was doing fantastic. Value took a back seat, and then it paused. It got up here and it was digesting, and now the Mag 7 growth is taking off. And we're not selling off on this, the right side. We're not selling off there. We're holding it. So we're getting this rotation in the market. It's good to see. So keeping an eye on this, watching to see if the resistance bats us down. And of course, there's reciprocal logic. How far away we are from VWAP on one side is how far away we expect to get from VWAP on the other side. Or, you can do the same thing with RSI, MACD. If I had a stochastic of 10, I can expect to hit 90. If I had a stochastics of 20, I could expect to hit 80. So reciprocation, we're above the anchored VWAP, kind of getting a little outstretched, but not too extreme yet. Keep an eye on it. It was an impressive move. Yields right now are a bit of a threat to us, right? We had yields rise as we went up. It was fantastic. It worked well, but at some point that gets too extreme, and then you know we can't have yields going like 4.5, 4.6. That's crazy stuff. Crazy stuff. So we have to be concerned that we're going to get too far too much, and then the markets will start to respond negatively to that. This morning on Bloomberg, they were talking about some announcement hitting Boeing this afternoon that was going to come out of Saudi Arabia. I've been streaming, so I don't know if the announcement came out or not. It sure looks like it right there, right? And this must have been sell the news kind of rumor. And I was concerned about this at the beginning of the day because I thought, man, I want to tell everybody to go buy Boeing because they just talked about it. But look, there was the buy the rumor, and now it's going to be sell the news. So I didn't tell everybody to go buy it. I just said watch the news for Boeing today because there's supposed to be an announcement. That was the safer thing to say because I didn't know if they were going to sell it or buy it. But when it comes to trading, hopefully you guys have heard that before: buy the rumor, sell the news, or sell the rumor, buy the news. So in this case, they bought the rumor, and now we're going to look for them to sell it. It'll be really bullish if the selling lasts, say, a day, maybe two, and it starts to go up again. And we've seen that sort of behavior before in things like ANF had that behavior. It's one of those runaway. I know it's Abercrombie and Fitch, and everybody's like, "What? Who trades this trash?" It had this runaway move, and then would stall for like 2 days, then it'd run some more, and then it'd stall for 2 days. Look how far that thing went. It's madness how far it went, right? From like $10 all the way to $200. So if Boeing now stalls for like a day or two and then it turns around and starts going up again, it's very bullish. And I hate Boeing. So I'm not a cheerleader championing this company because I don't like this company. It went from 128 to 208. It's a pretty impressive move already. So hopefully you guys had a good day. We got some answers. I love it when you guys have questions or topics that you want to address. It's fantastic. So think that over. This Friday, we're going to have another stream at 2 o'clock, and we can, of course, cover whatever topic you want. I generally focus on swing trades just to kind of stay in my own lane. We've got plenty of traders that live stream about the futures and intraday day trades. So I just try to offer something else, right? But of course, we can do those topics too. There's nothing wrong with it. It's just we have more traders in the house than just futures traders or just day traders. So try to give everybody a little representation. With that being said, if you do have topics you want to hit on, send me a direct message or any of the moderators. Really, we all like the recommendations and suggestions. We'd be happy to hear from you, and we will either find information because, of course, we've been here for years. We've had people ask for things, and so we've already done a lot that maybe you didn't know existed. We can just point you in the right direction. Otherwise, if you guys don't have any questions, I'd say it's a really good spot to wrap it up. I'm gonna say my dinner's in less than 2 hours, so I'm definitely not gonna get a snack. But I got to go clean the windshield off on the motorcycle and the headlights and all that. So we got back kind of late, and I didn't get them taken off, cleaned off. So I got to do that. Yeah, but then I can check all the batteries for the different cordless accessories that I have out there. Make sure they're all off the charger, and there's always something, right? Kind of piddle around in the garage. Yeah, maybe wax the bike a little bit. I don't know. So everybody, have a good afternoon. I'll see you all in the morning at the morning briefing. Later.